Good evening and welcome to Your Money, Your Call. Thanks for joining me again this week as we take a fresh look at property all around the country. Before we get to your calls, let's take a look at what's making news this week. And the housing market in at least Sydney, Melbourne and Darwin has seen growth recently, and it's causing a knock-on effect, according to the ANZ research team, with developer confidence now picking up. However, they also said that it would be the mining states that record the most pronounced growth rate for gross state product in the coming years. All non-mining states saw growth rates strengthen in the second half of 2013. However, there are factors which show that the mining states will be next, such as improved global economic conditions, low interest rates and the lower Australian dollar. And data released by the Australian Bureau of Statistics indicates that Melbourne is set to have the largest population of all Australian capitals. According to ABS analysis, Sydney and Melbourne each grew by almost 1.7 million people between 1973 and 2013, although the overall growth rate for Melbourne was higher at 62% compared with Sydney's 54%. In their release, the ABS says that if current trends prevail, Melbourne is projected to overtake Sydney and become Australia's largest capital city by 2053. The analysis is part of a population growth study showing Australian capitals have attracted 3 times more new residents than the rest of the country. With me tonight to discuss these stories and answer your questions is Brad Beer from BMT. So if you have a question about property, depreciation or any other subject, our phone lines are open on 1300 30 34 35, or if you prefer, you can email us on property@skynews.com.au. Welcome to the program. And welcome to you, Brad.
It's Margaret, great to be here.
Now, of course, we were going to have another guest, Michael Tees. He's unable to make it, but he has sent in a response to one of our email questions, so we'll be reading that a bit later on. But what about the top news story today with mining states looking like they're coming through? And I guess we need to make it very clear to the viewers that we're talking about mining states that are going to do well. We're not talking necessarily about mining towns, and there's a difference.
Yeah, most definitely. I guess mining states coming through is about money being spent in those local economies, and we're talking about state, not necessarily mining towns. So I guess there's revenues that flow due to money being spent in those states through to the state governments, and you know, mining towns are a little bit different to a mining state, I suppose, is what that's trying to say.
Yeah, look, and I think the important thing is that when money comes into a state through the mining industry, we see a lot of money being given back for infrastructure planning, and states do make a lot of money out of that mining. So it is expected that mining is going to have a bit of a recovery, and that will reflect mostly back in the capital cities of those mining states. But I think people still need to be careful about the big dangers of investing in mining towns.
Look, mining towns in general is you know, as we've said many times on the show here, there needs to be more than just the mine there in order to sustain growth, to sustain people living there, because the mine's too focused on one thing. There needs to be other fundamental reasons why people want to live there, why there's industry there, why there's money there, and there's other money coming into that economy in that state or in that local area. I mean, Australia's almost my thoughts, a situation where when much of the rest of the world struggled through GFCs, due to largely probably a lot of mining, we as a country actually fared okay because we still had a lot of things in the ground that we could pull out and therefore generate income, generate spending on infrastructure, etc., which is, I suppose, similar now to state-based flowing into the money flowing into the state government, etc., from mining towns.
And of course what we've actually seen happen in the last couple of years is that there's always a little bit of a trend when the mining industry is going really, really well. We tend to have a little bit less confidence in things like retail spending and consumer confidence in housing, and then when mining is starting to drag a little, we see more confidence coming through on the other side. And you know, it's an economic influence because the economic influences are very different, and I think what you say is very true. What it enables us to do, because of this diversity in how the country fares economically, when one sector is doing not so well, we have other sectors that keep us, you know, our head above water, and it certainly keeps our balance sheet looking pretty good.
Definitely, and we've had, you know, ups and downs in retail spending over the last, you know, few years, but at least we've had some ups. You know, retail's got a different challenge in online space and things like that, more than it's had forever. But it's still, at least there's a bit of confidence. We've got low interest rates and some other economic conditions that allow some spending and allow some stimulus, I suppose, for income and for economic growth.
Absolutely. Well, look, let's go to the emails, and in our first email we have a question from Gavin about both insurance and strata titles, and he asks, "Hi panel, we're about to settle on a freestanding house on a subdivided block that is strata titled. Now, according to the sales agent, each property, 2 separate dwellings with a fence in between, is entirely self-sufficient, and the disclosure statement says that there is no committee, no manager contributions, no contributions, etc. in place. However, I've been trying to get some building and contents and landlord's insurance, and most, if not all, insurers are saying that they can't insure a single property in a strata. They have to insure the whole lot, and the body corporate should be doing this. Now, how does that work in my case? From the plans, it looks like the whole plot of land is classed common property, but then each subdivided block is further classed as an exclusive use for 2 separate dwellings." Brad, I'm not sure if you know much about this topic, but do you know anything about this topic?
Look, far from my expertise, but I know there's a few different rules around strata when there's only 2 in the development. Like you can change whether or not you need a sinking fund and things like that. As far as insurance is concerned, I'm not sure the right answer to that. Maybe, hopefully, Michael's given an answer to that one tonight, I suppose. But I know it is a bit different for 2 as opposed to more than that.
Yeah, exactly. And look, my understanding of the small lot subdivisions that are subdivided into strata in this way is, once a strata exists, then there is still a requirement for a body corporate and a committee, but there may not be a requirement for a lot of the other things that these strata subdivisions normally require. So my understanding is that you don't necessarily need to raise levies if you don't share any common ground, and you don't have to have a proper strata manager, and you can kind of just manage it between yourselves. Now, I did ask Michael about this, and he has said that your insurer is most likely right, and that you do need to have a body corporate established, and if the agent is telling you that it isn't necessary, then the agent is withholding information from you. And he said that you need to have a look at your contract, and if the words SP appear anywhere in the contract, then it's a proper strata title. And I'm just looking at his email from here. He's also said that if it says PS on your plan in Queensland, no, PS in Victoria or CTS in Queensland, then you know you're dealing with a proper strata subdivision, and you will need some kind of a body corporate established. That doesn't mean that you can't get one established, but certainly Michael has said that if you would like him to discuss this with you and answer the question a little bit further, he's only too happy to do that. So just drop me an email at property@skynews.com.au, and we can certainly find out for you what more you need to do in this regard. But I think the agent isn't telling you everything you need to know, and you need to tread very carefully with this one. Now let's go to the phones, and we have a caller from Harvey Bay, and this is Pat. Pat, how can we help you?
Yeah, hello. I sell real estate up here in Harvey Bay, and I'm 65 and just about to retire. I just want to, how do you feel about Harvey Bay as an investment area? Because it's been a bit flat for the last couple of years.
Yes, it has indeed. And of course, Brad, Harvey Bay, which is H-E-R-V-Y, Harvey Bay, is an area that's been very much a tourism area. And I think for a while there it had that whole iconic, you know, beachside lots, and it really had a lot of interest. Then it's gone very, very flat. What do you think is going to happen with Harvey Bay in the future?
I don't know with Harvey Bay in the future. The fact that it's had some, like, it's been flat for a period of time, from what I understand. Like, I mean, Harvey Bay is the gateway to Fraser Island, which I've been to and absolutely love, but it still makes it a holiday destination, and it's always got risks associated with that, because especially in, you know, over the last period of time when we've had a really strong Australian dollar. It means that Australians don't often holiday in Australia, and also tourists don't come to Australia. So Cairns, Gold Coast, and sometimes I suppose Noosa or Sunshine Coast as well, often get affected by these things. But have they been affected by as much as they're potentially going to now? Providing the Australian dollar doesn't get too much stronger again, then maybe we get some tourism back in those areas. I still don't think tourism is always the best reason to invest in an area, though, because it is so up and down. Unless, you know, having a look at what else fundamentally exists in that area, when tourism fails in tourism areas, so do local businesses is a problem, and therefore so does the local tenants, unless there's other, it's a bit like mining, unless there's other industry and other reasons for people to be in those areas, it's always got some risk attached.
And certainly some good advice there, Pat, from Brad. One of the things about investing in these kinds of areas is that while we all know they're fabulous places to visit and to have a holiday in, typically their property is very sporadic and a little volatile. And you'll see when everything's going fine and fabulously in the country, those areas are normally going really well. People are buying in, they're setting aside property for their retirement, they're buying holiday properties, they're seeing fabulous returns, and then all of a sudden when things start to get a little bit quiet, the Australian dollar starts to increase and people start to holiday offshore, then those areas are affected. It's a little difficult to have a bit of a crystal ball. I think there'll be a bit of renewed interest in Hervey Bay, but I don't think it's going to have anywhere near the impact that it had last time, because you came off a lower base last time and already things are a little bit high. I think there's a little bit more pain for most of Hervey Bay, and then maybe a return to a bit more normal growth, but I can't see any booming or any skyrocketing there anytime soon, and I think it will forevermore remain that fabulous place to visit. And if you can get in at the right time and get out at the right time, you might make some money, but generally speaking over the long term it should perform a little bit under the trend. Thank you for tuning in our panel discussion this evening. Make sure that you ask a question, though, as then you might get a copy of one of my books. This week it's How to Achieve Property Success, and it's the combination of my first 3 books, updated and revised. It's the complete guide to buying property and covers everything that you need to know, from tax and gearing through to finance and conveyancing. Just call on 1300 30 34 35 or email property@skynews.com.au with a question. Then make sure that you watch at the end of the show to see if you're the lucky person. We're off for a break. Don't go away. There's more to hear and learn as soon as we return. Welcome back to Your Money, Your Call. Joining me tonight is Brad Beer from BMT. And with Brad here, I'm sure that you have a question that he can answer. Call us now on 1300 30 34 35, or of course you can email us on property@skynews.com.au. Now, Bavy wrote this week due to a problem he's having with settlement, and he asks, what right does a purchaser have to force a vendor to settle when he's not responding? Brad, I guess what's going on here is that we have someone who's bought Bavy's property and not settling. And I guess it's going to depend on the state that this is in. Huh?
It really, I think it's going to depend on the state and the actual contract, which we have neither of knowledge of. But it seems a little odd to, I guess, accept an offer on a property and then, as they come to settle, say, I don't want my money anymore.
Yeah.
However, you know, it could have been a long settlement, for example, and there could have been movement in the market and they're playing games. But I guess you've got to come back to the solicitor and the contractual agreement that's there to try and push that situation. But not responding is going to make it hard to actually make that happen, isn't it?
Yes, yes. Yeah, look, it's a tricky one, Bavy, because real estate law is different in every state. So in Queensland, time is of the essence, and there is definitely a time that protects both the buyer and the seller that the property has to be settled on. But it's different in every state. So if you're in New South Wales at the moment, there's definitely strict penalties if the purchaser doesn't settle, but if the vendor doesn't settle, then it's a little bit more difficult. If I were you, what I would do is I would absolutely call the Department of Fair Trading in your state and find out what the laws are with regard to a real estate contract, because it is going to be different, and because you haven't told us where it's from, it's difficult for us to respond to that one. I would suggest that it's going to be somewhere along the lines of your conveyancer will now settle them it's what would be similar to a notice to complete, so advice that it's time now to settle up, otherwise you're going to basically walk away from the deal. And then if that doesn't work, then I guess it's going to be a case of some kind of legal action in order to force that vendor to now settle. You've also got money tied up in this. You've obviously delayed as well, so you've probably not bought something else that you could have bought while you've waited for this particular one to settle. So there is bound to be some kind of legal remedy that you can take, which is unfortunate. I'm sure you don't want to be doing that, but absolutely give them a call, have a chat to them and find out what are the legal next steps for you to take. Most of those departments of fair trading have, or you know, the areas in each state, there's a different department that will govern real estate law in each state. Most of them have very good websites where you can actually download some rights and responsibilities as well. So possibly pop there tonight and have a look and see what you can find. Brian from the ACT, how can we help you, Brian?
Yes, good evening, Margaret and Brad. I have a son who's looking to buy his first property. He wants to buy a two-bedroom unit in Barton, in the Realm area, in Canberra.
Okay.
With the reduction of employment in the area, just sort of wondering what you feel is the, you know, if the property's going to hold value or whether it's going to drop away for the next couple of years.
Brian, is he living in that property or just as an investment?
He would live in it probably for the first 18 months and try and pay as much as he could off it, and then sort of he'd probably move away from the area and rent it out.
Okay. It's a good question. Brad, I guess Canberra is one of those areas that has... It never does anything amazing, but it doesn't do anything really bad either. It tends to be one of those fairly staple markets.
Yeah, I think so, although, you know, I've seen a lot of construction go on in Canberra over the last few years. Have been very surprised. Like, we do a lot of work in the ACT market on new, especially there seems to be a lot of new projects, and I keep getting surprised, going, how can 200 more units and then another 100 units actually sell, and they seem to have sold off the plan, they seem to settle with an okay valuation and get okay rentals. Now, I think in the last few months, due to government change, etc., that's probably not been as good, and I think the vacancy's a little bit harsher and the prices have been probably affected accordingly. Now, we're probably not talking about necessarily a new two-bedroom unit here. We don't know what sort of property we're looking at. But there's a big difference in play here. You're talking about somewhere you wish to live. Now, wishing to live when only for 2 years, I still think it's not necessarily a long-term living decision that we're talking about here. It's a short-term living decision, and what you're really making or trying to make is an investment decision, and therefore probably should be looking at it as a long-term investment decision as opposed to I'm going to live in for that period of time and try to pay it off. Let's think about investment or somewhere to live. Invest in something that makes money so you can then buy where you wish to live, I think is probably something to really consider, because they could be two very different things. Barton itself, exactly, I'm not the expert on, but you know, has Canberra already had the negative at the moment, that maybe there's some positive in the future because of that?
Look, there's a couple of components, I think, Brian, to the answer here. The first one is that Canberra in the last 12 months has grown by roughly 3.5%. And if you think about that, it's a pretty low rate of growth. It's just outpaced inflation, but it's lower than, you know, the interest that you're paying on a debt. So straight away, it hasn't really caught up. There is some concern about the market because of the potential public sector job losses, and you've alluded to that yourself, and that will, of course, impact on the market. Having said that, in Canberra, the average income is some 30% higher than the national average income. So housing affordability is much greater in the ACT because people essentially earn more who live there, and that's why the market doesn't have the big downturns that we can see in other markets when we face the same kinds of job losses. I think what Brad's trying to say is that you probably need to separate out your purposes. If your son is going to buy a unit in Barton, live in it for 12 months or 18 months, 2 years, and then potentially sell it to get into something else, it can be a good way to save money. And remember, it's a capital gains tax-free gain if it does grow in value from that property into the next property, because it's his principal place of residence. If he moves out of it for up to 6 years and then either sells or moves back in again, then it's also a capital gains tax-free gain as long as he doesn't claim a principal place of residence exemption elsewhere. So under those circumstances, any gain that he does make is actually worth a little more to him than if it was in a straight investment property. But if he is looking for that to be a long-term investment and he's going to buy it and move in and then turn it into an investment property, then the return may be less good for him, because I can't see a lot happening in the ACT. There's also a big oversupply of units coming up in the ACT, which Brad has also alluded to, and that oversupply could impact on the capacity of that property to grow. So bearing in mind that it's already in a low growth period, and more units coming on the market, that's going to further impact or at least stop it from getting out of that low growth period. If it's a pure investment that he's after, there's certainly better places to invest. However, if he does want to live in it and establish his principal place of residence, he's also got to be able to buy something near where he lives and works so that he has that capacity to do so. He probably should get some really good advice from a good qualified property investment advisor to help him make these decisions, and an accountant before he goes ahead with any more. Well, if you're sitting at home with a question now, call us on 1300 30 34 35 or email it to property@skynews.com.au, and we'll do our best to answer it right after this next break. Stay with us. Welcome back to the program. We've got a great show for you tonight. Joining us is Brad Beer from BMT, and if you have a question that you would like either of us to answer, call us on 1300 30 34 35 or email property@skynews.com.au. Now, Hayne wants to fast track his debt repayment, and he wrote this week to ask, I have accumulated equity in my investment property. Can I refinance and use the equity to pay down my home loan debt for the property that I'm currently living in? Brad, that'd be fabulous if we could do that, wouldn't it?
Well, there's no reason why you can't refinance and pay down some property in the home, but it's not really going to help you out a lot, because suddenly this debt becomes a situation where the interest on that debt's no longer deductible because it goes off your principal place of residence. It's interesting how often I come across the situation where had a coffee with a guy who knows a fair bit in the property space last week. Told me he had this spare $100,000 he's going to put into a property, putting it into his investment property because he's about to go and buy his principal place of residence and paid it off the loan.
Oh.
I said, did you put it in already? And he said yes. Because as soon as you put it into your principal place of residence, it becomes something that's the interest on is no longer deductible. And I think the question there is sometimes getting a little bit more educated about what you're doing with your money and how you're messing up your debt to make sure it stays in an investment, stays in an investment property, and making sure we're actually setting up our loans properly so that we're putting the money in the right places to make sure it's the most tax effective it can actually be.
Absolutely. And you know, Brad's right, and people do get very, very confused about what they can and can't do in relation to financing. There's nothing stopping you from going out and drawing up the equity on your investment property and paying that money off your own home loan. However, the loan that you draw up to do that, or that portion of the loan, will not be tax deductible, or the interest on it won't be tax deductible. Now, once you've done it as well, you can't undo that, and so you can't suddenly start paying it back and hope that for a better outcome. You have to remember that what determines tax deductibility on a loan is not what secures the debt, but what the money is used for. So even if you have an investment property that you draw up on in order to get a car, go on holidays, make extra repayments off your own home loan, the purpose for the loan was personal, it wasn't investment purposes. And the moment the purpose for a loan becomes anything other than investment purposes, then you lose the capacity to have a tax deduction on that particular part of the loan. So just check with your accountant and be very careful. We're just off for another break, but when we return, you'll have another chance to get hold of a copy of my brand new book, How to Achieve Property Success. Just ask a question and have it selected. The number to call is 1300 30 34 35, or you can email us on property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Margaret Lomas. With me on the panel tonight is Brad Beer from BMT. And if you have a question that you think we can answer, call us right now on 1300 30 34 35 or email us on property@skynews.com.au. Susan, you're from Newcastle. Welcome to the program.
Thank you, Margaret. Thank you, Brad. Look, I'm just wanting some advice. I'm currently in talks with my adult single daughter on ways for her to start her financial future. Obviously, possibly with an investment property. She currently lives in Sydney, works in Sydney, rather a high-income earner and large rent payer. I'm not sure whether she should be advised to buy in Sydney. My gut feeling is that she probably should continue just to rent because the price of property is obviously a much higher, and then perhaps choose a proper area more for capital growth, so that she can also offset her wage for tax savings. So a little bit of advice on whether you think not to necessarily think of where she's living as to buy, and what areas you may suggest that she would start her financial future on, starting maybe a portfolio of property.
Okay, it's a great question, isn't it, Brad? And of course, you know, Sydney, I guess, apart from the fact that the median house, the average house in Australia in Sydney is now $775,000 is the median income, but the price that the average Sydney person can afford is $640,000. So we're already $135,000 over what the average person can afford in Sydney, and with prices like that now seemingly hitting their peak, it's a market that there's probably not a lot more to wring out of anyway.
Yeah, so that's a sort of a bit of a negative on the concept of buying in Sydney. Now, I think that given young, single, not that that means you don't have money, but being younger means the opportunity to possibly have a whole lot of equity there when having not really any property or equity behind you means that you also need a fair bit of money to invest into that market. And if you, in order to get this journey going, you need to actually buy something. Now, you're going to need a fair bit more money to try and buy that sort of stuff than you are otherwise. The rents, you know, she might be paying a fair bit of rent, but there's probably still a pretty low return for the property owner, given that the rents versus the dollars often are not as good. So therefore, buying less expensive properties in lesser expensive areas that probably return a little bit better is probably a good starting point, because if you buy one, say, principal place of residence for her, for example, in Sydney, it's really going to slow her down because the payments are going to be high. Her ability to reborrow is going to be impacted really heavily on by the fact that she's going to have a really big mortgage there. And I still rent in a high-priced property, and I have a number of investment properties because I'm still in the market. I'm still taking advantage of growth in markets in property. But I probably can't necessarily or don't want to buy what I actually rent. And that's probably a similar situation for your daughter, I'd expect.
I would say so. And Brad has some good advice there for your daughter, Susan. I think with the Sydney market at a premium now, it's probably costing her a lot less to rent than it would be for her to purchase in that same market and just meet the interest on a loan. Yields are quite low in many areas of Sydney, and I'd suggest that at the moment she is probably in a better position to stay where she is, continue to rent, and as you've suggested, probably buy elsewhere. That way she can gain the capacity of buying into markets that look like they're on the cusp of growth. There's quite a lot of those around at the moment, and Brisbane is tipped to be one of the next really big areas to take off, following Sydney, although probably not quite as hot as Sydney, but certainly some good things looking to come through from Brisbane. But at the moment, Brisbane is very affordable. I said earlier that the median house price in Sydney is $775 and the average person can afford $640. Well, in Queensland, the median house price is $445,000. The average person can afford $540,000. And so already there's a big disparity there, and that disparity means that prices can continue to rise in Brisbane. But the yields are between 5 and 6%, so they're a good cover for the interest on a mortgage. One of the pieces of good news that you need to know is that in addition to her being able to keep renting now and buying her own investment property is that if she is in New South Wales, as long as she doesn't live in that property at any time for a continuous period of 6 months or more, she does retain the first homeowners grant for a future purchase of a brand new property if she wants to. So at least she can continue to invest, and still at some time in the future, if she does decide to maybe settle down and build a house of her own, she does keep that first homeowners grant for use as long as she's never lived in a property. She can own as many as she likes as long as she doesn't live in them. There's a lot for your daughter to learn though before she does invest at all, and I urge all property investors to become educated before they do anything else. Surprising how many people jump into investing in property and they don't really know anything. They might read a book or two, but they really don't know how to be good investors. I'm sure your daughter trained long and hard to get into her high-paying job. She needs to train long and hard to get into a high-yielding investment portfolio as well. So she definitely needs to do a course of some description. Brad, just before we go to the next break, I really wanted to touch on our second news story tonight, which is the one about Melbourne becoming a bigger city than Sydney. And that's certainly the forecast at this stage. Of course, it's only a forecast. But what do you think that's going to do to property in Melbourne?
Well, I guess it's like Sydney, it's funny, has always been the biggest. And it's funny, I even look at our numbers in depreciation schedules, and Sydney always wins, even if it has a slow patch. It comes back, and Melbourne will nip at the heels, or Queensland will. Sydney always just comes back with a vengeance, and like that's in our numbers, which I suppose is something around depreciation schedules done for property investors. Melbourne nips at its heels pretty heavily though, and lately is having another nip for us. Like I love New South Wales because I love the beach and I love the weather and I love those sort of things. But then I also love Melbourne. It's not somewhere I want to live for all of my time though as well. But I mean, for property, it's a good thing for Melbourne property because more demand for whatever supply exists, I suppose.
Yeah. It was interesting because last year, most experts were predicting a very quiet year for Melbourne, and it certainly began that way, and you would have noticed that. Not many people were getting depreciation reports done in the early part of 2013. But it really came through strongly at the end to deliver an 8.5% growth for the year. And while that certainly doesn't break any records, it was a very, very surprising result for Melbourne, and nobody really saw that coming. But it was led by investors.
And given that there was so much negative press around Melbourne for a chunk of last year, it's very surprising to see that sort of growth percentage come out of that market. And it's probably, there was a little bit of positive sort of later, especially in the, not right in the city, but outer suburbs a little bit, I suppose. So maybe that's driven those numbers.
There's also some I get a bit of deja vu when I go out into some of their suburbs, most notably the eastern suburbs. It's very like our Blacktown, Penrith area, albeit some of it's a little bit newer, but there's certainly markets out there that really look like those markets. A similar commute time, a similar big freeway that turns into a car park during peak hour, but similarly resourced and lots of infrastructure in those areas. And what we've actually seen happen in those areas is we've seen the demographic centre of Melbourne shift out to those areas so that they are the most heavily and densely populated from a family perspective. Now, what we've learned from the big boom out west is that family demographic is very much leading the charge on property price growth. And I can see very much so that out toward the Narrow Warren area and down to the top of the Mornington Peninsula there in Frankston, I can see very much that we're going to start to see a period of time in the not too far distant future where we get that really hot market out that way in the same way that we did here in Sydney. And
it's all closer as well. It's not so far to actually get to the city from those areas if you do still work in the city, and there's a lot of, I suppose, pockets in Melbourne where it's still substantially less to buy property than it is in the same sort of distance to Sydney CBD, I think.
Absolutely. So I think we'll see some real investor-led demand coming through in Melbourne, and Melbourne love their property. I don't think they'll disappoint again, and I think if you are looking to buy at the moment and you're looking for an alternative to Sydney, then both Brisbane and Melbourne are really presenting some fabulous opportunities. Well, thanks for being with us. It's time for a break again, but when we return, you'll have another chance to ask your question and possibly win the book of the week simply by calling us on 1330 3435 or emailing us on property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Margaret Lomas, and joining me tonight on the show is Brad Beer from BMT Tax Depreciation. Now, we've been answering your calls tonight, and if you have a question and would like to be in the running to get a copy of my brand new book, How to Achieve Property Success, call us right now on 1330 3435 or email us on property@skynews.com.au. Angela, you're from Melbourne. How are you going?
Good. How are you, Margaret?
Good. We've just been talking about Melbourne.
Yes, I heard, in Sydney.
Yes.
My question is, we're actually looking at moving to Sydney shortly, just due to work. We're selling our property in Melbourne. Just wanted to know what your thoughts are on using a buyer's advocate to look for a home interstate.
Okay. Look, Brad, I actually really like the thought of using a buyer's advocate if it's going to be for an owner-occupied property.
Well, yeah, I think trying to find, like I kind of often think about, and we had a discussion earlier about me being a renter, and I just think it would be so hard to actually settle into that. Well, I'm sort of stuck. Well, not that you're stuck, a little bit more stuck here. So actually learning a bit, or having someone who knows that area a little bit better to go, here's my criteria, and I'm pretty firm on what I actually want, then try and... But then on the other side of that, as a buyer's advocate, I'd think the owner-occupier would be the worst buyer because they've got so many more criteria around what you actually want. But if you can find one that's actually going to deliver that in the area that you want and in the price range you want somewhat, or with some knowledge of the actual area, like a decent amount of knowledge of the actual area, so they can help you to go, well, these are the schools, these are the good things that you actually want around your house that you really do want, and the streets to stay away from, I suppose, then I could see some benefit in that, definitely.
Absolutely. In fact, Angela, when buyers advocates were first invented, so to speak, what they were really there for was the person who's just like you, the one who didn't have a lot of time, was coming in possibly from outside the area and needed someone who was very intimate with the area and could write down all of the things that this person wanted and then narrow down the choices to a handful of properties that you could just fly in for the weekend, go and have a look at, be pretty confident that one of them was probably going to satisfy you. And more recently, they've started to morph into people who actually help property investors as well. I'm a little bit more sold on buyers advocates for people who are looking for a place to live. You have to live there for a long time. It's got to satisfy a lot of your needs, and at the end of the day, a buyer's advocate should be a good negotiator too, so they can probably either bid at auction or help you in that negotiation phase. I'm a little less convinced about buyer's advocates for buying investment properties because, first of all, it can add considerably to your buying costs, with many of them charging 8, 10, 12,000 and some of them a percentage of the purchase price. And few of them are actually true investment property experts. Many of them might know about the physicality of an area. They may be able to tell you about the schools and the kinds of things that are important to you as an owner-occupier, but whether or not they can actually work widely for you and help you to choose the very best investment property at that moment in time, wherever it exists all over Australia, is another thing. When you're an investor, you've got to be able to forget about what you like and where you think you should buy, and buy in the area that shows the fundamental growth drivers. And very few buyers advocates are across the entire country to help you actually do that. So in your situation, I quite like the idea of you using a buyer's advocate, and I think if you find one who's very intimate with their area, they definitely should be able to help you to buy well. Let's have a look at an email from Barry, and he writes, I've just bought a house in Metford near Maitland. It's a 3x1 with a pool with cash. Now, I'm moving there in a matter of weeks, but I still own a house which is a 4x2 in West Beach in Esperance, which is in Western Australia, with a $360,000 owing, and it's worth about $420,000. I'd love to know if you think I should sell and buy a more appropriate investment property or rent the house around $400 a week. Brad, I guess firstly, Barry has done something really good in that he is obviously renting out Esperance. He's used cash for his owner-occupier rather than pay cash off the house he was formerly living in and then raising a big debt for his owner-occupied property. What about Esperance? Should he keep that?
Well, I guess Esperance, I'm not high. I know where it is, but I'm not an expert in Esperance. You know, you've got just under or about a 5% return on the value there, I suppose, which is not, too bad from a cash flow perspective. So the cost of holding that, with the depreciation schedule, etc., shouldn't be too hefty. I suppose it depends on a couple of things. What are you going to use the money? Do you believe there's more growth in some other area? And I'm sure Margaret will have an opinion on Esperance for that. And if there is, then the concept of buying something that you believe actually will make some more money in the future is something that you really should consider. If you're going to buy an Esperance again, then you've got to look at the cost out and the cost in and go, well, maybe that's not the way to do that. But great that you've put the right money in the right place, I suppose, in the property you're going to live in, which is a good start. And Esperance, I'll leave with Margaret.
Yeah, look, before I talk about Esperance, there's a couple of other things, Barry, that you really need to think about. If you are going to live in this new property, which clearly you are as your own home, then you have to choose one of the two to claim your principal place of residence exemption on. And you would claim that on the property when the time comes to sell one of them, which has gained the most amount, because your principal place of residence exemption means that you don't get capital gains tax on any gain that you make. Now, let's assume that it's the property that you've just bought in Metford, and if that's the case, then that means that Esperance, now that you've moved out of it, is going to start accruing capital gains tax from its present value unless you sell it within 6 months. There's what's called the 6-month overlap rule, which allows you to buy a new principal place of residence and sell an old one and have that 6-month overlap, not a single day more. So you can still get out of Esperance without paying any capital gains tax if it has grown in value since you bought it, and that could be a good position for you to be in. I actually don't see a lot of growth drivers in Esperance at all, and therefore I think that with WA slowing down, already we're seeing more rental vacancies in Perth itself. We're seeing a softening of prices in Perth itself, and I don't see much happening in the regional areas like Esperance. Then I think holding on to it isn't actually going to achieve much for you, except that if you do sell it down the track and it hasn't grown, then at least there's going to be no capital gain to pay the capital gains tax on. If it's holding you back from getting into something else as a better investment, then a sell now could be a good idea. But it sounds like it won't be, because you've got full equity in your own home now. So it could be one, as Brad says, it is actually making a fairly good cash flow. It could be one to sit in there. It'll pay maybe off the loan with that good cash flow, although at $400 a week it's not fabulous cash flow. I'd be certainly taking some advice and maybe looking at a better place for your money and possibly getting out of it while you still have that capital gains tax-free period. We've had some great questions tonight, and you may have one too. So while we head off for a break, why not call us now on 1300 30 34 35 or email it to us on property@skynews.com.au. We'll be right back. Welcome back to Your Money, Your Call. I'm Margaret Lomas, and it's been a great night with Brad Beer from BMT. Now, we've been answering your calls, but if you have a question, call us now on 1300 30 34 35 or email us at property@skynews.com.au. Now, Elizabeth wrote to us and said, I have an investment property that I bought in 2008, and I know how much the property cost is to build. As far as I know, my accountant has used this figure every year for depreciation. What are the advantages of having a depreciation report done, and why do I need to have one done? Well, that's quite provident, isn't it, that we've got that email at the last minute. Brad, you can tell Elizabeth why she needs to have the depreciation report done.
Look, Elizabeth, in that situation with your property, you've got some actual costs available. Now, wherever possible, Tax Office likes us to use these actual costs, and we will use those actual costs to make sure that this depreciation has because depreciation has a relationship to that construction costs. The thing that we would do, though, is we have a look at those construction costs and how they've been provided. Has the builder just given you a total cost for construction and your accountant applied the correct rate to that? Then there's a level of okay in that, but then there's a lot of items within a property that get claimed at different rates that have values for the purpose of depreciation and method of costing for the purpose of depreciation that are a little bit different. So we would have a look at that and say, look, based on the number that's there with the claim, we think that if we actually look at depreciation in a whole new, do it correctly light, then is there enough additional deductions there to worth look at it? worth looking at. If there's not, and it's all right, then you just continue on what you're doing. But if there is, and it's not been done completely properly, you can easily backclaim a couple of years of your tax return and go back and sort of claim the difference in case you've actually been missing out on any deductions, because it's not quite as simple as just using the construction costs. It's all about pulling it apart and making sure you're maximising the deductions as well, definitely.
And you know, Brad, it's also worthwhile mentioning that certainly with BMT, that if you go and do a depreciation report and you can't get back at least the cost of that depreciation report, then...
Yeah, we don't charge you. So it's actually, if we don't get your deductions that are twice as much as the report actually costs you, then we'll give it back. And that even goes for that situation where your accountant's sort of making a guess based on the costs. We'll have a look at it and go, well, look, you're claiming $5,000, we think it can be X. If we don't get at least twice our cost in additional deductions in that year, we'll give you the money back, because we should know our stuff based on the fact that we do lots of properties.
Look, just quickly, it's my understanding, and correct me if I'm wrong, that you can make a guesstimate on plant and equipment but not on construction costs. Is that
construction
correct?
is where you really need to have a quantity surveyor involved if you don't have all of the costs, but then it's about expertise in those other things as opposed to making a guesstimate.
Yeah, absolutely. Well, I couldn't have answered it any better myself, so I've got nothing to add. And that's it for now. Thanks so much for being here and for the great questions. Next week is a public holiday, so we won't be here. But the following week, I'll be joined by Tony Hayek from Bluewell and Curtis Field from Colliers. So be sure to tune in then. Now, my guest this week, Brad Beer from BMT, did a fabulous job, and I know that he's going to be keen to be here again soon to answer your questions, and you can look out for him in the coming weeks. Thanks also to our callers and emails for your great questions this week. Now, this week we've agreed to give the book to Susan. Susan, your daughter is going to become a first-time investor, and I think you should be giving her this book. It's going to be just perfect for her to work out exactly where she should be buying and what she should be doing in terms of her investing. So what you need to do now is email me on yourmoneyyourcall@destiny.com.au. There it is on your screen, yourmoneyyourcall@destiny.com.au. Once you've done that and sent me your address, I'm going to send you a copy of the brand new book, How to Achieve Property Success, which is going to be perfect for your daughter. Now, if you missed out on getting the book, you can get it from my online store at destiny.com.au, but you can also get it from any good bookstore. Even some of the lousy ones tend to stock it too. Now, it's a great book and a must-have for every budding or experienced property investor. If you want to be ready to jump into your investment portfolio, you've still got a bit of time left to join our next round of essential property education courses at your local Destiny branch. Now, on the 3rd and 4th of May, I am going to be personally conducting a course in our East Perth branch. This is a one-time only. I won't be offering it again ever. So, for your chance to spend the weekend with me in a very small group of around 30 people at the branch for a great course, go to the website and check it out before it fills up. Thanks for being with us. I'll see you again next week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.